All right, welcome everybody. Thanks for coming to Deutsche Bank this afternoon. Just to introduce myself, I'm Jonathan Lonsdale and I run our securitization and repackaging programs for trade finance. And I'm also coordinating our approach to fintechs for trade finance distribution in particular. So I'd like to thank ITFA and all of the speakers. I think we've got a great schedule this afternoon and there's drinks afterwards as well, which is always good. So with that, I'm going to hand over to Sean Edwards, who's going to kick things off. Thanks very much.
Thanks. So thank you, Jonathan. Thank you for Deutsche Bank for having us here in this great auditorium. Actually, we're always very lucky with the generosity of our members. And Deutsche are a very active member within ITFA, sponsoring also our conference in Budapest in September and have helped us with a number of other things. One of the most active parts of ITFA recently has been around fintech. We've been very busy on that. There was supposed to be a slide of the board up here, and I was going to say, don't make a joke about artificial intelligence. Doesn't quite work so well without the slide. So what we have done in ITFA as really is one of our major areas of activity is around fintech. That's really down to Andre, who's done such a fantastic job over roughly the 3 years that we've set it up. When we kicked off our sort of fintech initiative in Edinburgh, really 3 years ago at our annual conference. For many people, including myself, actually, fintech was sort of like one big mass of fintechs, and it was sort of one thing that they all did, and no one really understood, I think, very well what the different specialisms were and could be. And I think now we're beginning to see a lot of differentiation, and that's important, not just for the fintechs themselves to survive, but actually to develop the whole ecosystem. I think that we are trying to drive with many others. So today is about, I think, one of the most exciting parts of fintech, namely the use of AI. Now, AI is one of those sort of science fiction-y words. I think we'll get a little bit worried that we're heading to some sort of dystopia. I think maybe the concern there is more around the use of AI in retail, and we've all, I think, been recipients of AI in our own day-to-day banking. In the case of trade finance specifically, the use is a lot more specific, and some of our members that are up here will be talking today. One of the areas I think that concerns us very much or concerns certainly the regulators and society as a whole are the ethics and the regulation of AI. And I'm very pleased that we've got Polina speaking today about that, who's written a very good paper in Flow magazine that I read. And also you're launching your white paper today, is that right? So anyway, there's a white paper available also on the sort of the ethical side of it. And it will be important also for trade finance. There's a lot of worries here about, I think, reinforcing biases and actually excluding people from the financial system. And if you take that to trade finance, of course, in relation to SMEs, that could be a problem. So I'm sure she'll tell us more about that. These are the fintechs that we've got today, and I think with that, we're going to start more or less on time, a few minutes late, with Polina, who is the head of GTB Digital Regulatory Strategy. Is that right? Great. Okay, I got that right. Thank you.
Okay. Good afternoon, everyone, and very warm welcome to Deutsche Bank premises. We're very happy to welcome you here. I'm heading regulatory strategy in GTB Digital, and this is one of the most, I think, exciting area, at least for me, to work in at the moment, because the regulations in the digital space is something that I'm looking after, and I'm engaging with the regulators and with the industry around the regulations in digital that are now forming and shaping at the moment. So this is quite an exciting, because we have an opportunity to engage with the regulators in an active manner, where we can share our insights on what we think about the practical implications of implementing the new regulatory frameworks. And clearly, artificial intelligence, machine learning is one of the examples, but not all of it. So there are many other initiatives. And today, I thought that it will be useful just to give a very broad and high-level overview of what are the key regulatory trends that we are currently seeing in the market that are shaping actually the market itself also. And clearly, being the bank, we are operating in a highly regulated environment, and that's no surprise that the regulators are taking keen interest in also how we deploy the new technologies. So some of it will be, clearly around how artificial intelligence is deployed by the bank, how blockchain deployed, how we can use cloud computing. But at the same time, there are a number of the new players in the market, and fintechs, firms is clearly one of the examples. And so it's also quite a lot of attention from the regulatory side at the moment on this as well. So I will move on with my slides and just to present to you a few kind of key initiatives, well, trends, which I think are the most important at the moment. So first of all, it's innovation. Clearly, all the regulators, they want the bank to innovate. They want the banking industry to employ new technologies. They want us to be able to compete with the fintechs. They want us to provide, better services to our clients. So with that in mind, in Europe, for instance, a year ago, European Commission have published their Fintech Action Plan, which talks about pretty much all of these, 4 technologies that I listed: artificial intelligence, cloud computing, open API, and blockchain. So because they thought that this is one of the most important let's say, technologies that the banks can employ, where they can benefit the most, right? So I will dedicate a bit more time to artificial intelligence, because that's one of the topics of our discussion today. But clearly, before I move on to the artificial intelligence, clearly just a couple of words about 3 other, definitely cloud computing, which provides a great computation powers and capabilities, is something that all the banks are looking to employ. And there are some outsourcing rules provided by the regulators, how you can outsource your service to the cloud services provider. So this is one of the biggest kind of developments of last year. And clearly, from regulators' perspective, they want to make sure that it is all secure, the way how we use cloud. For us, we want to be able to use cloud. So finding this right balance between, regulators regulating and requiring some cybersecurity protections and access and audit rights to cloud services providers versus us being able to employ this internally and to explain to our control functions how we can work with this is another story, right? Okay, so around artificial intelligence, actually, there are a lot of things going on in this space. Generally, the regulators' approach, they want to be technology agnostic. So they do not want to regulate any specific technologies. But when it came to artificial intelligence, what they realized is that the mass amounts of data that are currently available in the market, publicly or privately, it's a big data economy, right? And this pushes everyone to use and searching for the ways to how they can monetize the data. And artificial intelligence and machine learning, one of the ways of how this can be done, right? Clearly, the regulators, they want to allow us to benefit from this, but at the same time, they're concerned around what are the aspects of using the data for artificial intelligence and what can be the risks. One of the key focus at the moment is the ethical use of artificial intelligence and ethical use of data. So when it's all started, like sometimes a year ago, I think, where the European Commission, they came up with their idea to implement AI strategy for Europe, and then they have commissioned a working group to look into the ethical guidelines for the artificial intelligence. That was the deliverable that they have delivered already at the beginning of the year. And then the second part, which we are still expecting, would be around the regulatory and policy provision. So what they delivered, just a bit more words around it. So what they talked about is how can you use artificial intelligence ethically? And so what does it mean really, right? So in the retail space, I think it's more obvious and more clear. But when it comes to commercial banking, for example, it's all around, it's more like business ethics. So what is the purpose you can use your client's data for? And is it ethically towards your client? Do you need to tell your client how you use their data? So what are the circumstances? And well, of course, being a bank, you are not allowed to sell your client's data, right? And no bank are interested of doing it because this is their own kind of incentive that they can offer to their clients, and that's the benefit. But at the same time, there are a number of guidelines that they came up with as a result of it, which are not mandatory at the moment, but we're expecting that this might form the policy agenda. And these requirements, they're pretty much around how the artificial intelligence governance should be formulated. It is about that there should be human oversight over the artificial intelligence frameworks, and also that there should be transparency and explainability, and clearly the liability. This is a very high-level framework. What's going to happen next is the regulators are going to run some pilot use cases where the industry can provide their pilot use case and participate and to test how exactly a particular use case can play out using these guidelines. So in order to understand whether it's feasible or not. So we're expecting as a result of it, they might come up with some policy recommendations. The open APIs, it's basically the initiative, another kind of set of the requirements that allow us to connect with each other. It's open API, something allows us to connect with fintechs as well, which brings me to the next topic, is the open banking. Open banking, that's something that has been driving basically the development of the new payments ecosystem. And in Europe, it's Payment Services Directive, which now appoints and recognizes new types of the players in the financial market, and there's the third-party providers. They can act as the account information services providers or payment initiation services providers, and all together, this normally is the fintechs, the startups, but also the banks can take this role, right? So what we use in order to connect with these third-party providers are the APIs. It's not mandated by the regulators, but at the same time, that's something that the industry came up with. The Deutsche Bank also was part of Berlin Group that developed certain API standards for Europe. But there are some other initiatives in Europe, clearly. But at the same time, so I think this is one, of the examples how the regulators really can drive the change of the market. So that's how they can push the innovation, how they can push the competition, and by allowing new entrants to enter the market, they really, gave incentives to the banks also to compete and to think, is our proposition is something that we, really can match what they're offering in the market, or do we want to take a new role? So I think it's altogether it gives very interesting industry trend for the banks to think about. Mostly it is in the payment space at the moment, but there's some of the other jurisdictions, if you look around the world, for example, in Singapore or Hong Kong, they're looking to expand it broader. The new products is another big topic, right? And I think crypto assets, we were talking about them, I don't know, for the last 5 years or even more. Every conference I go, everyone talks about blockchain, crypto assets, but somehow it didn't really pick up. So interestingly, my personal view, the reason for it is because there were no clarity from regulatory perspective to really take this on a really proper level. And the reason for that is because the banks, when they take a decision, if they want to invest in certain products or if they want to provide certain services with regards to crypto assets, they need to be able to assess their risks. And without a clarity around what the asset is it an asset, does it certify certain rights or it doesn't certify any rights, what are the legal protections you can rely on. So this all creates uncertainties that really undermine the bank's ability or investors' ability to assess the risks. So this year, there were a number of publications which, to my view, might potentially drive a really big shift in the crypto assets from at least legal perspective, which means that it brings more clarity and potentially the market infrastructures and market participants will be more interested and willing to take on more business and maybe buying crypto assets or doing something around it. So at the beginning of the year, so there was a EBA report published. So European Banking Authority, they expressed their view what exactly among crypto assets would be treated as the e-money, and therefore they explained what exactly these crypto assets will need to comply with. What are the rules? So that would be the rules of the e-money directive, but also payment services directive. I think this is a big move forward because it brings clarity. So at least we know what type of assets are within this requirement and what exactly needs to be followed. Same way, ESMA, they also clarified their stance on the securities, crypto assets. So they call it crypto tokens. But the idea is that these are the bonds or shares issued in the tokens forms on the DLT. And they confirmed that these assets should be regulated exactly in the same way as they are regulated by as any other assets, securities issued on traditional form, medium. So this is again a big step forward in terms of bringing more clarity. And altogether, if you look at it, it's just, I would say it's just 30% of all of the crypto assets that are currently available in the market, but it is quite a big, step for this essential assets where you would normally see, investors using them or for securities to invest into them. There are a number of regulatory issues around it because we're talking about Europe itself, right? But there are many other countries, and if you really think about doing an IPO or ICO, you would want to do it not only in Europe but also in the States, for example, or in Asia. But then the question is how all requirements around the world will interconnect with the requirements provided in Europe. So whether you will be able to issue it everywhere you like or not. So this is something that is still stopping, but the good news is that the regulators at the moment are working on further developments, and there was a recommendation to European Commission to come up with some pan-European level regulations and to consider further what about the other 70% of the crypto assets, what do we do with them. In the UK, they already started the work around it. They are about to publish their guidelines around how to treat those 30% of crypto assets, which pretty much would be aligned with the vision of the ESMA and EBA. But at the same time, they'll look into regulating and how to expand their regulatory perimeter to those 70% of crypto assets that weren't covered by the current regulatory requirements. So with all of this, I think it's shaping in quite an interesting story where we can see more and more clarity from regulatory perspective can drive more interest from the investors to invest and from banks to participate in these projects. I think just to as the last trend, I think is the biggest trend is around data. And data is underpinning everything we're talking about, right? So if we talk about blockchain or artificial intelligence, cloud, it always is just about data, how we store data, how we exchange data, how we use data, how we analyze it. So all these rules, it's all about data. Clearly, data is regulated and it has been looked at for already a number of years. And we have recently had general data protection regulation last year, which has been quite a big development in this area. Free flow of non-personal data in Europe, again, has been another one. So because the key issues around data is data localization rules. So if you look into applying some technologies across the globe, so you would want to make sure that whatever you use in the States, you are able to use it everywhere else in Europe or in Asia, right? So you don't want to create multiple solutions for each of the jurisdictions. So, and with that in mind, clearly there are some regulatory barriers for the free flow of data across, jurisdictions. But for some major jurisdictions, there are some good solutions. But the data privacy requirements is one of the, I would say, the most cornerstone for this, and that defines how you can move the data across the borders. The most interesting, I think, area is. Which I currently observe is the something that emerged from open banking. It's called open data. So that's a next level of the availability of data, of bringing the data that we have on each of us as a retail customers, right, or for our clients, corporates, or financial institutions at the next level. So, and what is it exactly is where open banking says, you as the bank, you have to open your client's data to anyone who has been authorized by your client and knocks the door, right? So you open up this information and they're able to use it the way your client have instructed them to use. What happens with the open data is now there are a number of other companies and entities like fintechs or big techs like Amazon, let's take as an example, that consolidate enormous amount of data. And this amount of data, they analyze it around analytics. What they do, they sometimes provide free services in exchange of your data in order to cross-sell some products and to offer better services to the clients. So the ability to use some of the data that they have, right, is also some opportunities for the banking community, for the fintechs, for the consumers themselves. And this also puts more into control the consumers themselves and the owners of the data if they're able to designate and direct the data that somebody has got about them to a person that they think that can extract most value of it. So from this perspective, there are a number of initiatives, and one to mention in Australia about opening up more data, not only by the banks, but also by third parties. And there are some discussions here in Europe around competition policy. So that's in this region. So how the data concentration, data accumulation on one hand can undermine the ability to run your analytics or really compete even with one with another, and what can we do to open up more data in this space. So that's clearly, from my perspective, some very exciting topics to look at. And just being aware of time, so I think I will wrap this up. Just to mention very quickly what what has been mentioned at the beginning is just our white paper. So I published it last year, end of last year. So it covers all of the regulations around artificial intelligence, blockchain, cloud computing. So please feel free to go at our Flow website. So that's our special, thought leadership place where we place all of our insights. So with that, thank you very much for your attention.
Good afternoon, everyone. Just very briefly, my name is Joanna Wissing, and I work at Lloyds Bank within trade finance. I also have worked for a fintech for about a year, so I'm one of these bankers actually that left banking, went to fintech, and came back. Having no regrets there, neither way, not for leaving banking and not for coming back to it either. Was a very exciting and very interesting experience, and particularly at this particular point in time. I mean, yes, as we've all been saying today already, we've all talked a lot about fintech, we talk a lot about developments in the market, but sometimes there just seems to be a kind of like information overload and overflow, and that's exactly the reason why in must have been around September 2017 time, just before the annual conference, ITFA actually created the Fintech committee under Andre's leadership, which I'm very happy to be part of, and still am, even though I'm back to being a boring banker, which of yeah, of course. Bankers must be boring, no? That's probably the best way to address it. But basically, I mean, the ITFA Fintech Committee really was founded to educate the market, particularly the trade finance market, about what is out there and what kind of like are the different offerings of fintechs and what is the overall ecosystem. And it's probably best summarized by having a look at actually the ecosystem map. To see what we've got out there. So as you can see, in terms of the kind of like trade infrastructure, we've got, of course, our different types of actual entities within trade, like who's relevant here, like corporates, SMEs, and FIs, trade originators, and you've got your investors. So when you're looking at your secondary market side. And in terms of like broadly to say what are the type of like fintechs that we have out there, we have the ones that we would say is corporate to originator. So that's basically the ones that are offering, let's say, a third party platform, for example, in the supply chain finance space, to actually allow corporates to use that third party platform that then banks would normally still be the funders under it, hence we were calling it trade originators. Whereas rather than having to onboard on the individual banks' platforms, you got the originator to investor, so that's really a lot of the kind of like secondary market platforms that we're seeing out there that are in the space of basically helping banks to run their syndication business, which today is an extremely manual business, a role that I used to do with great joy and really enjoy because it is a very interactive market, but there is certainly a lot of paperwork on the back end of it as well. And there is platforms out there that are saying, actually, we can make that more efficient for you. And then you've got the ones that are basically covering the entire spectrum. So they would be originating an asset from a corporate that would be then funded, for example, by a bank, but that could actually be even on-sold again to an investor. And you've got your communications infrastructure. That's, for example, also the companies that are looking into data. And data certainly is important across the board. So we've just spoken about it, and we're going to speak about it a lot more. Anyone who's ever looked at trying to find the right MI within a bank to make sure that we exactly know what are our limits, what are our exposures, how much money are we making for these clients, will know how difficult it really is to get good quality data. And then, of course, trade operations, very important there as well. And we'll hear more about today how certain fintechs can help with actually improving processing, improving operations. And again, particularly trade finance has obviously been way behind there compared to, let's say, the payment space. simply because there is so much paperwork and so much manual labor still involved, and certainly also a lot of bespoke cases rather than, let's say, the payment space. So just to see at kind of like which type of platforms would we be having, we've kind of like broadly looked at what do platforms normally try to offer, what do fintechs try to offer to make a difference to the market. And yeah, again, we've spoken about data already. Data is definitely a very big point, and it's something that you'll hear in a lot of the different fintechs offerings, and how a lot of the different platforms actually approach it in a different way, but all with the same aim of collecting data, being able to manage data better, and being able to kind of like literally by the clicks of a few buttons pop out the information that is required, rather than painfully and painstakingly going through a million Excel sheets and combing through a million files to actually compile it all together. You've got what we call the trading platforms. I mean, those are really the sort of platforms that a corporate can use, again, to kind of like, well, have trades originated for them, get pricing information, how you have the auction platforms in that space as well, or the kind of like RFP platforms. And then you've got the machine learning bit, which we will obviously learn a lot about today, because that's the main topic of the day, which is really exciting because if we look at past sort of attempts, for example, in the trade space to come up with tech solutions for at times very manual processes. The reason why a lot of that still can't be processed just straight through is because there might be discrepancies, for example, in underlying docs or so. Machine learning can certainly help with that, in terms of if this one and the same discrepancy keeps on popping up, that actually is just, let's say, a lowercase letter rather than a capital letter, the system should be able to pick that up, and that should not come up as a discrepancy again. Just as one example of where machine learning and AI can actually help the process. But again, we'll hear a lot more from the experts, which by all means I'm not. So I'm very happy to introduce the panel, and I'd like to ask probably Rebecca, ladies first, to come over here and tell us about your solution. Thank you.
Yeah. Okay. Thank you very much indeed, Joe. You'll be very relieved to know that I'm not going to talk about trade wars today. I normally stand up in front of audiences and tell them how the world is going to hell in a handcart, but I think Donald Trump and President Xi are doing that quite well enough by themselves at the moment. So I'm going to talk to you instead about the data that goes behind a lot of the talks that I give in the public domain, but also how that is now turning into a bank solution. The company is called Coriolis Technologies, and the technology itself is called multilateral. And I hope during the course of today I'll be able to explain why the technology is called multilateral, but we believe that trade is multilateral. We all have a common objective in promoting multilateralism as a way of trading together, and so our technology is actually the connectors that join the dots between disparate data sets and disparate data. Our very firm belief as we were setting up the company is that the future of trade is data. If we understand data flows, if we understand what governments are doing, if we understand what politicians are doing, if we understand what businesses are doing, and if we understand what banks are doing, then we can understand an awful lot more about trade and start to make useful decisions, save ourselves a lot of time, be able to benchmark what we're doing to answer your question and your pain point about how do we actually have the correct management information systems. So what we're building effectively, we call it the Bloomberg for Trade Finance. It's a very global macro picture of what's going on. So it gives a set of indicators about what's going on in the market, and it is very much a tool for making decisions with. So what's the problem that everyone in the banking sector faces when they're providing trade finance to SMEs in particular? The problem is the cost of the unknown. I remember someone from Commerzbank at Cybos last year said to me, Rebecca, it's all very well, you can tell me that you're checking this and you're doing that and you're checking against OFAC sanction lists, we can all do that. We know all of that stuff. Our problem is what we don't know. And we don't know what we don't know now. Nobody does. It's the unknown unknown. But if we don't know what we don't know, then we can't insure against it. And therefore, we might end up with some kind of a risk. And therefore, we can't actually finance the SME sector. And it is that reason that it gives us this fabled figure of 1.5 trillion US dollars of unmet SME demand for trade finance. The reason is that the due diligence costs are high relative to deal size, the data is disparate, it takes no account of company behaviours. And so we need to have something that allows us to analyse company behaviours, allows us to understand quickly and effectively and efficiently what the market is, where the returns are, and where the risks are as well. So what we've done is we've started to assimilate data, aggregate data onto our platform that allows us to be able to do that. And the consequence of that problem of the unknown unknowns, if you like, but knowing that there are risks out there, is that trade finance itself is underinvested as an asset class. And I don't need to tell anyone in this room that that is the case. But I approach this from a very global macro point of view. Some of the other solutions are more at a micro level, looking at company data in particular. This is an aggregated solution. This is an aggregator solution. It's bringing data from all over the place onto one platform. So our goal in the end, as I said, is to be the Bloomberg for trade finance. So there's a whole bunch of data issues. Company data is all over the place. It's disparate. It's missing. There are bank issues. There are no trade finance benchmarks. Plenty of banks know exactly what they're doing and have estimates of where they sit in relation to market share. But there isn't a systematic benchmark across that aggregates all the transactions data anonymously, anonymizes it, and provides benchmarks. It's very difficult at the moment to bring KYC techniques, AML, and know your transaction techniques. They're all costly, they're all time consuming, they're all manual, and bringing it all together on one platform is actually what's necessary in order to save time and in order to save money and save resource. And as I've already said, the standardized benchmarks that are out there, well, they're very limited to say the least, and creating a global macro picture of what's happening in the sector, not just from company level data, but also from the macroeconomic data, what if analysis, what happens if we have a trade war, what happens if tariffs rise, what happens if oil prices rise to trade. That's where we're going with this data, to create those types of indicators, those type of lead indicators, but also those types of metrics at a bank and company level as well. So, the problem, as you've already seen, is much bigger than KYC and AML. And it's about aggregating all of this data. We're very fortunate. We're working with a lot of partners to be able to do this. So it very much is in the data aggregation space. And we have three areas. We take publicly available data. We develop that publicly available data with bespoke sector data, so bank data, logistics data, and company data, and then we augment that with data that comes from the digital footprint of banks and of companies as well. Contextual data is poor. It's publicly available, but it's very poor. I came from a session this morning at an academic organisation, and I've told this story to a couple of people already, but I was frankly appalled. I've known it's there, but I'm going to make it public now. They were from the OECD, from the World Trade Organization, some of the best research organizations out there that advise governments and advise businesses on a consultancy basis. Put up all this marvelous data about where value was being created, about supply chain linkages, value chain linkages, all of this stuff. And then I looked at the axis. And the most recent year was 2014. Our governments are basing their analysis of what is happening around Brexit and what is happening with trade wars and tariff policy. And our businesses are being advised from these organisations which are basing their data on stuff that is very, very old and lagged. It's a big problem, so we've solved that problem. The bank and transactions data is very sensitive. Again, I don't need to tell anyone in this room that the data is sensitive. That's already been made quite clear. But we're developing a technique with Intix as well to anonymise that data so that we're just looking at flows by sector, geography, and trade finance product to be able to provide indices and benchmarks. The other problem with the data, it's all over the place, multiple data sources, varying frequencies, varying latencies, and all the users in the trade space have different requirements. So companies need something different to analysts, to investors, to banks and relationship managers. Everybody needs something different. We need to benchmark performance, we need to assess credit ratings, we need to know about country risk, counterparty risk, reputational risk. Trade is big. It's really big. You would not believe how big trade is, she said, paraphrasing the Hitchhiker's Guide to the Galaxy. So what we're doing is we're taking all of this data onto one platform. Yes, it is a huge platform. Yes, we are assimilating a lot of data, but we're taking transactions, credit scores, company behaviours, we're turning that in, and we're matching all of that with the macroeconomic data that we have as well to create an end-to-end risk solution. So from the onboarding process right the way through to the end of analysing trade policy and analysing business strategy and formulating strategies. Just to summarise, the sector needs data. The data is disparate and sensitive. We need data because we want to risk manage and we want to benchmark. The data is disparate and sensitive, so our technology is creating all of this data. It's using AI, it's using machine learning to create unique analytics around it so that we can understand what we're doing. And just to make a little plug for Andre and Intix, and Intix is our aggregation partner to anonymise any sensitive data, so we don't see anything that's sensitive at all. So this is our partnership with Intix. We're taking data transactions feeds, and aggregating and analysing them, and then that gives us the capacity to have increased understanding of trade opportunities and therefore increase trade finance and make it an investable asset class. So we're working across this with Intix in order to be able to deliver anonymised benchmark data. This is what our terminal looks like. If anybody wants a demonstration, there's a little link down there. I'm happy to provide a demonstration. Marcus, my colleague, is also here to do that. But what I've done here is I've just taken almost a joke supply chain, and I've looked at tea in China, porcelain rather than China. And I've looked at exports and imports. I've looked at the trade finance flow. This is 2017, but if you go up to the little filter button in the top right-hand corner, you can see our projections as well for all of this. We have the trade finance. You can click on that. It goes through different types of estimated trade finance flows. You can see where the key flows are in each of the countries. You can see who the key players are, and you can see what's happening. We've got China, Sri Lanka, Kenya, India, and Germany, big trader in tea as well. And you can see how the tea and the porcelain equipment is actually, the trade is very closely correlated. Now what we do then is we show how the trade finance is flowing around that sector. We take that down to an individual company level so that you can see who the companies are that are trading in this sector. We look at annualised growth trends and patterns and project what's happening as well. And then we're bringing in news stories about what's happening in that sector and looking at the key companies in a particular market, who they're trading with abroad, and then looking at their patterns of behaviours to see if there are any AML, KYC risks associated with them. And a lot of that is about their digital footprint rather than just about checking against OFAC lists and so on. And the big thing that we do alongside all of this, and we're visualising this at the moment, so unfortunately I can't show you, but it's actually, we look at the political risk metrics in all of this as well. So one of the unique things that Coriolis does is actually provide a really clear picture of political risk in each of these countries so that we can look at a relationship between a sector and corruption or internal conflict, external conflict, terrorism, and so on. So it gives us an idea as well, and allows an agent or a relationship manager or an investor to look at the relationship between trade and political risk as well. So here's our solution. This is what the final platform in a few months will deliver. And we're starting, one of our biggest clients is in Africa. We're starting with the Africa platform, and we will have that launched by the 1st of December. So all of this will be available in Africa. So our theory is if we can do it for Africa, we can do it anywhere. So our final platform will have a very strong element in robust, publicly available data that we've assimilated. We will then link that to real-time trade logistics, trade credit, insurance, port and satellite data, and we're integrating all of this with one of our data partners who is assimilating and ingesting all of this data for us. We're then linking to a company-level digital footprint to establish supply chain transparency, because everybody knows that upstream and downstream supply chains after tier 1 level is actually very difficult, both for companies and relationship managers. So we're using AI to develop supply chain linkages, so we can match directors to directors, and we can match markets to markets by company. And what that does is it provides us with a moving map of where those supply chain, it's a graphic map of where those supply chain linkages are developing. It's very exciting development. And then we're using AI to explore and train data to make those connections between disparate data sources, so we can look at the companies that are more likely to be trading in dual-use goods, for example, or the companies that are more likely to be trading in certain markets where the risks are higher, so we can aggregate all of those as well. And then what we're doing as well is we're creating a company level user forum. So this is for SMEs to access all of this data. That's what we're developing in Africa. We're developing a supply chain forum as well. And what we believe all of this does is it links the companies, the flows and the risks all in one place. It's suitable for through the value chain, if you like, of trade finance. So what to expect, and when our basic trade data will be ready by the end of, our basic trade data platform will be ready by the end of June. In fact, it will be ready by Monday, but I'm saying the end of June to be on the safe side. Technology projects always slip. What that does is it gives us very detailed data for HS codes, dual use goods trade, strategic trade, and some of the hidden trade that the data that our mirroring process, our artificial intelligence mirroring process produces that you can't get elsewhere. So for example, we know how many bombs America is exporting to Saudi Arabia. Now, the reason why that's an important piece of information, we can then link that back to the companies who are supplying that, and we then know who the banks are that, or who the governments are that are funding it as well. Probably oughtn't to say that outside of this room. I notice all the cameras are on. There is an armoured car outside. Trade analytics, so analysing patterns in trade and looking at where some of the company opportunities are. We will have a full trade finance estimated suite, so we will have trade finance indicators there of letters of credit, of open account, credit insurance, and so on, and yields, and we will have UK-based company data as well. By the end of November, we'll have all of it integrated. We'll have company and value chain links, we'll have logistics data, satellite data, and political risk sensitivities alongside a proper what-if analysis. So either a relationship manager or a bank or an investor can have a look at trade flows and market developments and opportunities against political and economic risk and changes in policy. And all of this is involved, is also has a predictive analytics capability. So the AI is driving analytics around supply chains and trade finance as well. And then, as I said, we will have this Africa user forum. My final call to action. Multilateral means multilateral, she said, paraphrasing the famous Brexit means Brexit phrase. We have multilateral technology. We believe that we are moving ourselves in a direction where we can genuinely say that we're connecting unusual data points together in a way that is meaningful and useful for the sector using artificial intelligence. It allows us to develop data as a service, analytics as a service, but also to develop the world's first understanding of digital and services trade as well. Alongside that is multilateral thinking, and this is the most important part of what we're doing, because it's very important for the sector that the sector kicks back against some of the policy things that are going on, because we understand the restrictions, we understand how flows move across borders, and we want to be able to keep funding the businesses that trade internationally. So between us, we actually need this data to be able to go back to governments and international agencies and say, do you realise the consequence of the policies that you're implementing at the moment? This is industry-led data. We want to show you what's really going on. And this is me kicking back against my profession, which I'm a lapsed economist, by the way. I'm probably an economist still. You never lapse. You just use your models. So we're creating an R&D network globally, but we also want to create a partnership with banks and with logistics companies and so on to allow us to be able to have a data for data exchange. We will be anonymizing data. We don't need anybody's data in a raw format. We just want anonymized data. So to achieve our goal, we need financial flow data by sector, trade finance product, geography and flow. Intix is pulling the data from the systems without touching bank systems, which means it's provided onto our platform in a totally anonymized way. We don't want to know which bank it is, we don't want to know what the client is or anything at all, purely anonymized. We don't want to know the names of the clients, and we match the flows that we have against data that we can pick up through digital footprints. This is the artificial intelligence process. So we hope that you will come with us on this journey, that you'll become a multilateral partner with us, and you will have the first access to all of these benchmarks and all these risk tools as they develop. Thank you very much for listening. Thank you.
So I'm Christophe Juman. I'm a Frenchman, so sorry for the accent. It's not Brexit yet, but I will stay here after 23 years. I'm not going anywhere. And so I'm going to talk about Taulia. So actually, I need you to put yourself into your corporates, your customers, your relationship you have with a corporate treasurer, with a CPO, with a CFO. We are supply chain finance solutions and working capital solutions for the corporates. Okay? And what we're trying to do at Taulia is we want to basically liberate cash within the supply chain. But when I talk about the financial supply chain, we talk about both as a corporate. I've got customers and I've got suppliers. And we want to provide that ecosystems for the treasurer, the CPO, the CFO to be able to manage their cash and liquidity and also their data transactions. So we've been actually around for 10 years last Sunday. So we had cake and champagne at lunchtime, which was very good. You had some bubbly, I didn't. I was serious. And we've got one platform. Within that platform, there is also an AI component, which I'll talk about. But you can imagine we have, I would say, trillions of transactions. We have 1 million daily interaction of users on the platform across over 120 customers. Customers like AstraZeneca, Airbus, some local councils, like my council in Surrey, all the way to a Telstra, to a Rio Tinto, etc. So we take all this data of those big corporates and offer working capital management. And that means many things and nothing. So actually my objective is to show you how we at Taulia want to bring the sell side and the buy side into a liquidity management. And some of the things I'm going to talk about are here today. I've been for a long time. Some of the things are in the making this year. Some things are coming. But this is all about how we're doing this within our product and where AI fits. So actually what we've seen as our customers is managing working capital, some of the function in treasury and finance were a lot seen as a cost. And a cost, it was just you could say transactional data. This was operational costs. But what's evolved is having, if they had the right tool, they could make better decisions. And the health of the supply chain, de-risking the supply chain, where to invest compared to having the trade information, this platform. If they have the data, then they can become a more strategic function. And this is where they are today. A lot of the development and things we do is based on those C-level relationships where the customers say, I want my team to have that data available. Where is it today? Oh, it's on that spreadsheet over there, on that spreadsheet over there. So that's where we are going. It's changed, and we're listening to our customers to that. And if you have all this transactional data, that creates an opportunity. And to have a full value on an end-to-end financial supply chain, the opportunity is to have all the accounts payable, accounts receivable documents. Imagine you have that at the touch of a button, instead of scattered around your ERPs or your reporting tool, etc. And if you have all that, you can optimize your cash. So at the touch of a button. And so if you have those information, you're going to then move into looking at any benefits, any losses, any risks, and how to address this within your organization. And finally, if you can give these insights and through the artificial intelligence suggest actions. Hey, go and talk to the department in France for this set of supplier within that section and get them to change your term, or actually you're approving your invoices too late. Go and get your departments to do something. So then it becomes actionable. So there is, and before I move into, let's say, product things, I started doing business intelligence with DHL in 2000. It was a business intelligence platform that we developed. He had data cubes, and he had lovely screens. That was reporting. Okay? There was no intelligence. There was our intelligence, and we are telling this is the reports we want. You've got robotics. You've got predictive analysis. So is that AI? Is it machine learning? Too many jargons. It's too complicated for me. I talk to the data scientists, and when they talk, I'm like, I have no idea what you're talking about. So you've got reporting. You've got artificial intelligence. That's got a lot of things, predictive, and you've got machine learning, which is the machine itself will change the behavior or what they're predicting. So that's where we are. So it's been quite a journey at Taulia, and we started in 2006, and I'll talk about our evolution. What time did I start? Because I didn't look. So at Taulia, we do several things. So think again who you are. You're a corporate, you're a treasury and finance. You have a working capital to manage for your company. You've got trade finance. It's part of your portfolio. And I want to deploy cash. I want to unlock cash. What do I do? So within our platform and solution, one solution, we actually do dynamic discounting. We do supply chain finance. So here we've got different flavors, supply chain finance. I'll come on to that. And we do actually use AI part of these products. So we do the transactional data. Once we've got all this data talking to the corporate's ERP, then the artificial intelligence have got business scenarios. There is no report, there is no predictive analysis, there is no machine learning without a business need and scenario. And we've got scenarios that help deploy and utilize cash within the platform. We're also using that to do, planning to do pre-finance invoicing, AR financing, different flavors of AR financing. But the key things around this is we don't do it for just a few large suppliers. The supply chain finance program or any of those programs utilizing or deploying your cash, we do it for tens or thousands of suppliers in the supply chain. Okay, so those programs have got thousands and tens of thousands. It's the entire supplier, the Christmas tree guy to your huge tier one supplier. It's across the business, which is a bit of difference from traditional implementation, especially on supply chain finance. But actually, if it's in one platform and one AI that tells you what you can do, then you have the tool to decide when do I use my cash, when do I use third-party cash, what do I do with my payment terms extension. So then if you have this information, you can make it actionable. But to be doing this, I'll go a bit faster, we actually need also some purchase order information, some invoice information. And if we have those POs and payables, we get much more. Then you can look about, late approval, prompt payment. Hey, how is it going? Oh, here's my dashboard. Who's the guys who are not approving in time to pay in 30 days my SMEs? And so if you have all the right documents, which is the transactional data that powers the working capital, we're doing purchase orders, fraud, on internal fraud, payables fraud, and all the invoice validation and automation that you need. But again, behind all this, we've got AI that drives the decisions. You have predictive analysis using the AI to say, this is what should be planned. The AI will look at it, say, this is what happened, this is what worked, this is what didn't work, so this is what you should be doing. So across all this, in one platform. And this is live today. Some of those functions are not there yet, but it gives basically Treasury a way to, in one place, look at all their assets. And the asset is, how do I manage my working capital? And how do I take the data efficiently? So in 2006, we had our first, we called it AI, but for me it was more of a predictive analysis reporting tool, where we had our program data, but then we started injecting third-party data to augment that data to provide better information. So that was our first generation, went to a third generation. I think we're on number 4 now, where we actually did, okay, what's the predictive analysis to optimize your programs? Regardless if it's AR, AP, supply chain finance, dynamic discounting, e-invoicing automation, what are the prediction and optimization of your programs? We also build AI around payment terms. What payment terms should I offer? Do I break the prompt payment code? Yes. Okay, do it, because it's broken for 98% with the customer of that supplier. It's out there. So yes, go to 90 days. Don't stay at 60. And one thing that became obvious back in 2017 was supply chain health and risk management. I think there was a tsunami at some point, and there was some sort of leak in the plant somewhere, and then some supply chain got really impacted. So if you have this data again, you can see the trends in your supply chain and the risk points. Then what we moved into is scenario building and suggestion through the AI. So all that is there. So where and how do I deploy cash or use cash? So I can factor some of my invoices, or I can go on maybe extend terms here, or use my cash to get some discountings. One more. And the latest things we've done, which is right in the AI space, is about 2 months ago we've announced a partnership with Google, more Google allowing us to be partner with them. This is Google. So at Google Next, we're announcing one of the 5 or 6 partners to use their new document AI technology. And they've selected a few partners depending on their business processes. And for us, it's all around the working capital cash management. So here, we want to enable, through their AI, more throughput of invoices to fuel the supply chain and the transactional data. And so that's very exciting. So that's where we're using AI. So we're using their beta version. But what we want to be at is we are now right in the middle of doing cash forecasting. So when I talk about those levers, it's about recommending how forecasting your cash, what's happening, but also make it actionable, depending on the levers that the treasury or finance needs to manage. And what's quite in terms of predictive funding risk, this is, for example, on inventory financing, purchase order financing. You need to have AI who will predict automatically what is the risk to fund that supplier and how much haircut do you take. So that's where it is at the moment. And the AI is going to be critical to this. But you could do this on a spreadsheet today. It's being done today. Why do we use AI? Because we want to do it not for 10 suppliers. We're going to do it for 10,000 suppliers at a click of a button. That's the difference. That's the power of the technology today. Okay. And if you think about the prediction, applying that judgment to look at all that dynamic, you can unlock, deploy cash, and drive into your organization, look at the impact, and drive the actions. So some of those things Our customers are not there yet, but we can change rate, we can change term, we can push things automatically and not have a human in the loop. Today, we still want a human in the loop. In 5 years, there probably won't be any human. All those things will be actioned directly with the ERPs. How does it look like? In terms of the journey, I just need 2 minutes. Yeah. So if you remember the evolution since 2016, this is just a dashboard. We've had those for 20 years. It could be in Excel. No, however, it's an interactive dashboard because this is what's happening to my program. So it could be supply chain finance program, AR finance, AP finance, could be dynamic discounting, could be invoicing, doesn't matter. Then you can look at what's happening, you can click and go and drill down. And then the AI will tell you, well, this is what I recommend, what's happening. But this is just a nice dashboard. Then what you do, you add context data. So I think, the previous session you talked about adding data. So you got your ERP, your corporate data, and you add insights from everywhere and see what's happening. Like here, for example, you can see also what your peers are doing, etc., and drive the intelligence. And then you can look at the gap in your supply chain or demand chain. So what are the gaps? Oh, so why am I missing? Why am I missing here? Whatever, I can't read it. So whatever that is. I know this one is late approval of invoices. So there's 400K trapped in late approvals. So click on that, and then there's recommendations coming behind. This is a dashboard that says, okay, so I've just come out of a meeting with the CFO, and he wants me to find, $500 million in cash. Where am I going to get that? Okay, here you go. We've got all the data. The artificial intelligence will look at the trends, what the suppliers are doing, all the information, and come up with the suggestions. But also, cash forecasting is very important. It's not just what's happening today. It's what's going to happen for the next 6 months. So we've got all those also in place. We're just piloting the first customer around this. At the end of the day, it's about having clear action for the users within a corporate and being able to have real-time feedback. So I like your analogy with 2014 data. We refresh this data daily. Every day, the AI, the data, so the transaction data is refreshed, and the predictions are changed and learn from what didn't happen or happened. And that's the power of it, where it doesn't have to go someone to run a spreadsheet, do another extra, and a week later or 2 weeks later, you've got your answer. And all that drills down into the operational impact. It could be at company level, it could be at a business unit level, at a department level. There you go. Thank you.
Thank you very much, Christoph.
Good afternoon, good evening, everybody. My name is Samir Sehgal. I'm the CEO of TradeStream. Before I start, thank you so much, Sean. Thank you, Andre and Johanna. You guys are doing a terrific job, by the way, at ITFA. I mean, it's a very, very, very good job that you're doing. Before I start, I just want to make a couple of confessions. One is, I thought this was machine learning, so I didn't prepare a customer deck. So, there's very little about TradeStream per se. The other is, I'm an ex-banker. So, getting an ex-banker to talk about machine learning, it's not the easiest thing. So, I've tried my best. If I'm not able to answer a question that you have, don't worry, my team can, but I'll try my best. So, let me start by first sharing with you what's at stake. What's at stake is basically this: $23 trillion worth of trade globally. From pen to plane, everything is in that $23 trillion. And that's what, at the moment, is suffering. And the reason it's suffering is because all of it, no matter what you buy or sell, has to be documented through paper. And that paper has to be processed. And everybody is contributing to it. Banks are contributing to it, corporates are contributing to it, the freight forwarders are contributing it, ports, customs, everybody is adding on paper because the entire system is based on paper. Cumbersome, mundane, but that's what reality is. So if you look at it, 1/5 of all the shipment goods globally, shipment price, is basically linked to the processing, is linked to documentation. Can you imagine? If suppose that was not really happening, whatever we buy on the high street would be at least, to start with, 20% cheaper. That's the impact. humongous. And therefore, not surprisingly, this is something that is topical in everybody's minds. This is a survey that the ICC conducted in 2018. A lot of these items were not there 10 years ago. In fact, none of them were 10 years ago. I don't think Andre MT798 existed 10 years ago, or was very early at that time. APIs, I don't think so. Electronic bills of lading, they didn't. We talked about bills of lading, but not electronic bills of lading. None of these existed 10 years ago. But this is what's most topical on minds of banks at the moment and bankers at the moment, because they can see this coming through. There's this wave of technology that's coming. Machine learning and artificial intelligence are just few of those pieces, or two of those pieces. But there's a whole wave that's coming, and that's not just changing banking. It's changing a number of industries in its wake. And in fact, to be honest, it's converging industries. So from our modest outlook, we think that in the next few years, banking, insurance, logistics, transport, there's a huge convergence that's going to happen out there. They're going to merge, the boundaries are going to sort of diminish or just completely disappear. And it's technology that's causing it. And these are not just words, to be honest, and I'll go through some of these a little more in detail, but it's not just something out there. As you mentioned, it's not high-tech sci-fi out there. It is really happening in day-to-day. And we use these technologies in day-to-day to be able to bring that convergence together, because it's making things so much faster and so much more accurate. So what's TradeStream? TradeStream is a company that was born about 4 years ago. We are roughly about 100 people across the globe in 6 countries. We basically took the problem of documentation or processing and said, should paper really exist? Should processing really be off the back of paper? Is there a better way to do it? Is it not anachronistic that today we are dealing with paper when we go back to our normal lives? When you go to the airport, you don't use those flips or those counterfoils that we used to have some years back. You just use your phone and off you go. Cards, Oyster cards. I don't think we use cash anymore. So why should there be paper in the processing that we do, and why should it be so cumbersome that it takes 4 days, 5 days, 6 days at every instance for it to be processed? So TradeStream was born of the notion that we could actually do with the current technologies and do it much faster and do it much better. Obviously, we had to then go back and see how best to do it. And the best machine that we could find, the best system that we could find, was the human being. So we had to actually, we went back to our drawing board and said that if suppose a system or a machine were to work like a human being, what do humans do that the machine will have to replicate? That was the starting point. So when you look at documents, what do? We see it first, right? So there's a faculty of sight. So we had to build the faculty of sight module, if you will, which is what's called OCR, optical character readers, which has the ability to basically, when you scan the paper, to pick up the data elements out of it. Now, it's easier said than done, because in a trade documentation, as we all know, there are hundreds and hundreds and hundreds of pieces of information that need to be taken out. And it has to be done accurately. So if the user has made a mistake, you have to actually replicate that mistake. You can't correct it on your own. It has to be exactly the same that's on the paper. And it has to be done accurately, and it has to be done faster than the human being. So that's the first step, optical character recognition. There were optical character recognition tools in the market, but they had only been tested on visiting cards or checkbooks. And at the end of the check, there are those 4 or 5 numbers that need to be picked up, not 2,500, 3,000 data elements. So we had to evolve it to be able to do it, and there's a lot of machine learning that goes in, and I'll explain where it comes in. The other one was, so now you've got the data, and you've digitized the data. So all the paper, all the data has been taken out, and it's in the system. You have to intelligently pocket it, so make sense of that of that data, understand which data belongs to the bill of lading, which belongs to the invoice, which belongs to whichever document, and then once you pocketed it, you need to smartly decide on the basis of the data whether the transaction is kosher or not, whether it's compliant or not, or whether there are any discrepancies. Now that, as we know, in corporates and banks is done by people who spend 10, 15, 20 years gleaning all the rules and regulations of the UCP and all sorts of rules and regulations around the world to decipher whether that transaction is kosher or not. We had to build all of that into the system. And you can imagine what sort of machine learning, because this cannot be, you just can't keep on coding rules. This has to be dynamic to the situation, to the document, to the country, to the regulation. So we had to build all that machine learning and artificial intelligence tools, and I'll go through them in a few minutes, as to how those come in play to be able to check the transaction. Now, this might be boring, but what's the end result that we want to achieve? The end result is that when you get your piece of paper or your documents on the trading on the trade floor, you put it through a simple scanner, not a $20,000, $30,000 scanner, a simple scanner that you and I can afford, $200, $300. It's not in the scanner, it's in the platform. The platform has the ability to pick up that data without mistakes or very, very few mistakes, to be able to do it very, very quickly, to be able to run the rules in the background and be able to give you out the discrepancies in the matter of 5 minutes, probably even lesser. That's what we are building. And we are very close to that objective of getting it to that stage. We also, in the interim, go out with the data, because the data is on the documents that's been picked up, and go to various sites outside, third-party sites, to be able to verify that the transaction is kosher from a compliance perspective. So OFAC, voyage, geography, where the shipment is, whether the price is right or not. All of those verifications get done. So in the same time that the transaction is getting checked, the 5 minutes, you get the compliance feedback as well. So coming to the subject at hand, machine learning. We use a lot of what's been depicted out here. I mean, to be honest, these were there were jargons for me, but there is a certain rationale for each one of these. So for example, if you look at clustering, when we have to intelligently pick up data from a document in the matter of nanoseconds or seconds, you need to be able to focus on something called clustering. Clustering is basically a beneficiary name is going to come with a beneficiary address in the country, likely, and the probability of that is high. So if, so for example, my invoice is going to be very different from somebody else's invoice. If that's the case, I could write my beneficiary name on the top left-hand side, somebody could write it on the top right-hand side. System has never seen it before. But on its own, the system through machine learning needs to understand, and through clustering, you use that to be able to identify which data elements that it's seen should be put together. Use supervised learning where the system, once there is an error that's been made, the user basically corrects it. And that correction is remembered. So you think of the system like a child, a very intelligent child who does not forget. So once you make that correction, the system remembers it. And remembers it so that on going forward, it does not make that mistake. And it keeps on evolving. So when we started our journey, kid you not, the errors that were being made with the human industry that we had checked out were about 2.5%, 3% in the industry. And we were about 10%. And through machine learning, exponentially, with every passing document, transaction, data that we are sending it through, we are down to less than 0.5%. And it's going further and further and further and further. It's almost like an exponential curve which we track on a monthly basis. And all the others as well, reinforced learning, recursive machine learning, all of those. We use a lot of these machine learning in our system. Another place that we use is rules. So for example, one could write a 3x3 bill of lading issued from port A to port B by so-and-so company. I could write it on the transport document in that manner. Whereas in the LC, you could write it exactly the same meaning, but in different sense, different English, or structure it differently. Using NLP, we basically make sense of it. And we use machine learning to zero in into the right meaning of that clause to be able to take the right decisions from a system point of view. Because when the system is deciding what needs to be done with a certain clause, you cannot get it wrong. You need to do the right checking. So we use machine learning to be able to do that. That's what the human brain is expected to do. This is just a very small section of what checking is done on the shop floor, but it's amazing what humans have been doing all this while. You got so many parties, you got so many documents, each need to be checked against each other. There are so many attributes, 2,500, 3,000 attributes. You need to make sure the transaction is not, is compliant. And guess what? On a Friday at 4 o'clock, you'll get a big commodity player to come with a big transaction that needs to be processed in 1 hour, and the operating person on the shop floor will have a very difficult time being able to do it. I guess many a times, and please tell me if I'm wrong, your best friend is Google. Because you need to put all that data onto Google and pray and hope that there is no SDN hit and there is nothing non-kosher price, and then you can handle the transaction. That's what we've basically automated. I mean, this is just an example of machine learning. So it goes in and it's a recursive machine learning algorithm that's been put in place. We are also starting, in fact, we've been using it now for 6 months, neural networks. So neural networks are the next level, wherein they work, almost like some extent like Markov chains, where you basically have weighted averages on basis of different streams. To give you an example where we use this is OCR. In OCR, what happens is that no one technique is going to come up with 100% accuracy. So what you do is you run the first technique, then you run the second technique, you run the third technique, then you build algorithms so that it picks up the best answer, so that you get as close as possible to perfection. So where do we see this going? We think where the industry is going, and I think this goes beyond machine learning, so stop me if you think that it's not pertinent, but we think that the industry is going to change, and it's going to change drastically. Other industries have done so already. We used to own cars, now we have Uber. We used to go and take holidays in hotels, now we go Airbnb. We used to see movies, now we see Netflix. I mean, it's just changing. Nobody owns. You use, but you don't necessarily own. But if you look at the banking sector, what's happened is that we use our own balance sheet. I say we, I was an ex-banker, but banks use balance sheet, but you don't necessarily need to use balance sheet. You can risk fees, etc. And as Johanna was saying, that's very often the case. There is a convergence that's coming because of all that's happening in the other industries and technology is bringing it. So we see, to the point that was made earlier about the ecosystem model, as a bank, as an institution, one should look at oneself as an ecosystem. It's not just lending, it's not just a letter of credit, it's not just supply finance. You could actually be a purveyor, you could be a seller of all those capabilities to your customer, because ultimately who's winning on all of this is the end customer. So all these sectors in the form of logistics, in the form of blockchain as a tool, distribution of assets, MT Swift, all of these are going to come together. They're going to come together on one site, and the corporate is going to, and the client is going to benefit. We do talk to a number of banks around the world. At this stage, we've got probably about 14 or 15 different mandates. We've got 28, 30 different pilots going on, 100 different conversations going on. Usually they fall into this bracket or these brackets. So, there is either that bank which has a legacy platform but has to completely change now and has to get into digital banking interface. So they have to build that interface. We see the new bank who says basically I don't have, and there are a lot of emerging market banks who fall into that category, who don't have a system, who basically need to build, and now they're in a lucky position because they don't have any legacy problem. They just build it again. You have the distributed bank, and a lot of our customers fall into this category. We're talking to a number of fintech providers, and they basically aggregate it together and service their client. And then you've got the disintermediate bank who says that, okay, I've got a capability, I've got a few capabilities, but I look at you as a service provider in an evolved ecosystem model, and I will build the social network because that's where the future is, and I'll offer it to my customers. Most of our conversations in the last few months, quarters, have been in scenario 3 and scenario 4, because there's clear realization that the customer is not getting what he wants in the trade space. So where do we go from here? I mean, a lot of these technologies and a lot of these capabilities are already there. One might not be hearing it on a daily basis, but believe you me, these are all there. These are all slowly and gradually manifesting themselves in the trade space. And lo and behold, a few years down the road, when you wake up, you'll not even realize the difference, because this will just become a part of your BAU, business as usual. So this is all happening. Where are we headed from here? Where are we 2019 headed from here, 2 years, 3 years from now? Service as a business model. So OPEX versus CAPEX. No CAPEX, OPEX. Use it, leave it whenever you want it at your own will. Utility and shared service models, we've talked about integrated and financial supply chain. So the physical supply chain, logistics and transport, there's a lot of automation happening out there, huge amount of automation. And all that data is going to come into banking. And as that comes into banking, it makes the banking decisions a lot more intelligent. So from that perspective, that convergence is happening as we speak. Third-party APIs, I think that was referred to already. Smart contracts, and I think it's the next level. So it's 3.0, if you will, of trade. So the first phase of trade, the second phase of what we are going through now, the third phase is basically going to be around blockchain and DLT. I think there's huge runway for that. And some of the use cases and applications that we are seeing, including ourselves, what we are developing, is really exciting. I mean, the other day we did a transaction in 11 minutes, which would have taken 28 to 29 days. So it's really exciting. And truly, the end of ownership. You don't need to own it. It's a myth that you need to own things. Thank you.
obviously would love to hear from the audience, but perhaps I start because I've been frantically scribbling things down. I did learn a lot today, I must say, particularly on, of course, we all know about the value of data and how important it is for solving actually so many pain points around, for example, the corporate's cash management decision, around the KYC angle, the AML angle, around actually improving processing and speeding things up. So it's really good to see these great offerings in terms of like the analytics space and really helping here to increase and enhance processing and make transactions hopefully also quicker and safer. Speaking about the KYC point though, and that's slightly an aside now, but very relevant for me from a bank's perspective. If I wanted to work with one of you, what's the sort of like onboarding process in terms of would you need to have access to my systems? What sort of like integration would be required? Generally, like how would it work from your perspective? I mean, I obviously know which forms I have to fill, but how? And maybe Rebecca, you can start and tell us a little bit about Coriolis and multilateral in that regard, and then we just go through the round.
So the whole point about multilateral is it doesn't touch bank systems. So a lot of the AML KYC data and just general behavioural reputational data that we're picking up comes from the public domain. It's the data that's out there. It's the Google solution, if you like. The data's already out there. What we've done is we've looked at all of that through a trade finance lens, an onboarding lens, and put it all in one place that has desensitized it in terms of in terms of examining individual transactions. Now, if we are going to achieve the goal of having bank data, then we need to pull aggregated data, but we don't want your personal data, we don't want your client's data, we don't even want to know who you are as a bank. We send that information, or you send that information through the intakes, they clean it, turn it into something that's structured, and then supply it to us, and then we provide you with your management information system, if you like, that has the has all of the checks that you need, but also the benchmarks against, you know, trade finance products and market share, and so on.
That's great. Thank you very much. I see very little interaction that in that regard required, which is very helpful. I'd warn you about the quality of some banks' data.
We know about that, which is why we're working with Index.
Exactly.
Yeah.
Absolutely.
Because I think well, I mean, I was chief economist at the British Bankers Association, and there's a huge melting pot of data within that, the British Bankers Association as was. And I tried to look at it with a view to understanding it as an economist in there. And the data is, when it's raw, it's unanalysable because it's so disparate. And the goal of this, working with an aggregator and an anonymizer and, you know, a system that uses AI to clean the process. And one of the important things that we do is mirror. So we do this with trade data flows already, which is we take a flow from A to B, and then we take the same flow from B to A, so an import, export, and mirror it, and estimate what we think it is from that bilateral flow. Mm-hmm. And we do that across the whole world with every single trade flow that we see. Now we can do the same thing with this type of process, so we can infer what's happening on the other side from the data that's there, so we can work out from the AI process more about what's happening by that mirroring process. So the anonymized data allows us to do that mirroring and estimate what we don't know, which is the big $1 million question.
That's
$1 trillion question.
$1 trillion question, exactly. It is. That's great. Thank you. Christoph, what about the onboarding for Thalia from a bank's perspective? What would be
so
required?
from a reverse factoring perspective, traditional supply chain finance, KYC has always been expensive and difficult. And this is because of the trade regulations that a financial institution needs to cater for. So I like your diagram because Thalia provides the end-to-end. So our solution, we have a key partner in Greensill Capital, provide a service to us at a partnership. We have an SPV structure, special purpose vehicle, but there's a gap in between. So we are the corporate originator. They provide a service to us as an originator and distribute the assets to the investors. So our structure has disassociated, let's say, the financial institution regulation, and we are still a technical provider to a corporate. We use their master data because we are connected into their RP. So actually to onboard, including, I'm not talking about payment regulations, because we have to do that, that's part of the service, but to onboard a supplier and supply chain finance, it's a matter of registering on the platform and having click-through. It's not about contract, it's not digital contract where I still have to upload, sign and upload like certain provider. It's really a click of T's and C's, and it takes 90 seconds. Otherwise, we have a program on General Mills, we have 21,000 suppliers, and it took 12 months. That doesn't happen if you have to take paperwork, et cetera, et cetera. So that's the reason we have this working capital management, because we can go to the entire supply chain. If we had the KYC, we couldn't provide that liquidity management to our customers, because we would not have all the suppliers on.
So has any supplier ever questioned the T's and C's?
Well, they have the T's and C's. They are part of the education material we send to them before they get contacted and onboarded. And part of the click-through, they can look at the T's and C's in multiple languages.
So nobody wanted to ever negotiate them?
No, actually, sometimes it's our customers who want to have different things in there. So we do have specific customer T's and C's for their supply chain. But for example, we have a program down in you talked about Africa, in South Africa. And I think in 3 months, we had 92% of the suppliers click through and were ready to transact. Doesn't mean they are taking early payment, but they are on the program.
That's very impressive for supplier onboarding, definitely. Yeah, and if I, as a bank, wanted to use Tallier as my supply chain finance platform, what would you like? Where would you need to have connectivity in, let's say, other systems internally or so, especially the very old systems that aren't necessarily up to scratch?
As a bank, as an investor, you'll be going through our partner with the distribution team, and you'll be the investor into the asset of that program. So you keep a relationship with your corporate. It's your corporate, but you can work with us. Of course, if it's a new investor into our structure, we'll ask for the corporate to introduce the three-party, and we'll have a discussion, and you can fund a percentage of the asset. So there's no connectivity. We've removed that. You have to choose. There's a couple of different ways you can invest. It means you keep your relationship, and you don't have to invest in the technology. You leave the onboarding, the technology to us. You keep the relationship. You just fund the assets. Pick and choose. And I think if I was sitting here 3 years ago, like on some panels, the banking industry were not open to do this, to not have their own platforms or use a bank's platform, but it's still my platform through a provider. Now it's like, it doesn't matter. I don't want the pen anymore. So we see a lot of our new partners who are just investing in the program through our structure.
Thank you. And Samir, I guess for your obviously offering, it is key that you actually onboard onto a bank's platform and systems, and you've already kind of like shown the different ways of where banks could be in that journey. But how would you say, for example, a bank that's been around for several hundred years, they've got their 20 different legacy systems for processing letters of credit, for example, how would you go about working with them?
Just integrate with the platform that you have. It's very, very, very simple. In fact, to be honest, to your question as to what it will take to onboard, we could literally do it over a coffee. As long as your supply chain processes, because usually where we really get caught out is basically the bank's own vendor management practice. If those processes were streamlined, believe you me, we come with a scanner, we'll give you a scanner, and off you go. If you want it to be on the cloud, we can put it onto AWS or Microsoft Azure. If you want it to be on-prem, it's within your premises, so data is with you. It's as secure as you are today. And you just scan your transactions, and we'll tell you exactly how the system is performed. If you like it, we can implement it. Implementation means that it's your own trade, backend, whatever platform you're using. You just continue to use it. We use APIs and connect into it. It's very, very, very simple.
That's very good to hear. Yeah, I mean, speaking of the vendor risk management process, maybe a message for any aspiring tech entrepreneurs out there. If anyone could come up with a really cool, clever, smart AI and machine learning technology for actually speeding up the vendor risk management process, I think a lot of bankers in this room would be quite happy, actually, because it's definitely something that makes it difficult sometimes to work with fintechs. It's not so much a KYC or an AML thing. It really is that actual running through that process. So yeah, any tech entrepreneurs out there?
But I should add, I mean, and to the point that Christoph mentioned, I have seen an exponential change in the last 3 years. You know, there were these, you know, sort of legacy issues that, you know, you can't do this, you can't do that. But the wave that we are in just now, and please correct me if you don't see that, but the wave at the moment is massive. There are lots and lots and lots of institutions, corporates and banks who are saying that, look, we want to do this. And they are finding ways to get around vendor or work through the vendor management processes. So it's changing. Huh? It's not the same that it used to be.
I think I'd have to agree with that. And the biggest thing actually has come from the pressure that you were talking about, the various sectors within trade converging. A lot of this has come from the logistics companies and the shipping companies that are actually offering very short-term trade finance. And the tech companies, they're disintermediating banks more than the fintech companies are. So the banks are now saying, okay, we're going to work with the fintech companies because that gives us a solution against this disintermediation that's happening in the sector. So I think that's actually the window of opportunity that we have at the moment, and certainly we haven't seen the onboarding process being as complex as maybe it might have been a few years ago.
That's very good to hear, and I hope that we can speed it up more and more. And definitely the firm I work for, we're a big user of fintechs to work with our clients for exactly those reasons. Yeah, Christoph.
I was just going to say, it's great to have the data, but there are data security. Everything's in the cloud or is sitting somewhere. There's data security. There's GDPR usage of data. That is what's becoming more and more difficult.
Yeah, it's regulation.
You know, we have customers that don't even give us the data anymore until we have certain things in place. Where before, you know, it's not just a contract in place; it's other things. So that the scrutiny will potentially change, hopefully evolve in the right way, but it's sometimes an impairment to do those interfaces and getting this data using the AI.
I completely agree, and I would say I've witnessed the same. That definitely the kind of and it's probably because the regulation is not always quite clear, or the law is not always quite clear, and you have potential grey areas, and nobody wants to go into a grey area in a bank these days. Making a bit of promotion in kind of for ITFA. The Market Practice Committee certainly does keep an eye on things like that very closely and addresses them as part of the wider work that ITFA is doing. So certainly I completely agree. I think that is a big aspect, and something that we also discussed this morning as part of the Trade Finance Distribution Initiative. So yeah, there's definitely a major focus on that. Have we got maybe time for a few questions from the audience? Any questions? Oh, yes, please. Oh, hang on, there's a mic coming your way.
I'll just address one to Christoph, and you may or may not be able to answer it, but to unlock cash for a corporate or any organisation, you've actually got to be sure it's in the bank account. So are you connected to the bank account? And a subsidiary of that question is, are you supporting GPI?
Okay, so I didn't hear the last part of your question.
Are you supporting GPI?
GPR?
That's SWIFT, yeah.
Okay, so
global payments.
Yeah, global payments. Yes. So through basically the structure, for the data and the structure we use, we have each supplier's bank details, and we will make payments to those suppliers on behalf of the corporate. And we actually sit using the city infrastructure for our payments, which ensure all the regulations are in place. So we are depending on what's out there. Does that answer your question? No. Okay.
Now, on one of your slides, you said unlock cash.
Yes.
Great slide. But to unlock the cash, you cannot use it unless it's actually verified it's in the bank account. And there are banks offering various types of dynamics to show organisations the cash is in, SMSs, all sorts of things. I'm just asking if you are connected to that to validate the money is there, and then they can go off and use it.
So in this context, from a corporate, unlocking cash is looking at their supply chain and the payment terms, and it will be do a payment terms rationalization or extension to unlock cash as a one-off. That's what that means in that context. Yeah. So, yeah. Sorry, I went already, you change the payment terms, but you got to have a trade-off with the supply chain, the suppliers, which is paying them early. So then there's a payment infrastructure.
I'd love to go on, but I know Andre is waiting to start his, Daniel is waiting to start his session, and we've overrun already. Thank you very much. That was very interesting and definitely learned a lot. Thank you.
Afternoon, everyone. My name's Daniel Reimer. I am a banker. I haven't worked for a fintech company, but I am part of the fintech committee. So I'm looking at sort of the second session, which is looking at how machine learning and data technology can be used in the trade distribution space. Particularly looking at how we can capture data that's held within banks' IT systems or trade originators' systems, and using that to make better buy-side decisions. So key fintech attributes. Fintechs operating in this space hold on, what's going? Sorry. Yeah, great. Fintechs operating in this space are offering banks very unique, bespoke, tailored solutions. They're not bound by bureaucracy, they're very nimble, and they're using the latest technologies to create new market opportunities for banks and delivering it at a very low marginal cost. By collaborating with fintechs, it enables banks to deliver new product solutions to the market much quicker than if they did it themselves. I would say the benefits of working with fintechs, in the way we should view this relationship, is it's more of a symbiotic one. It's one whereby it doesn't interfere with our back office systems. The way we work, it just means that we can be more productive in our processes and get more insightful insights into our customers and creating other opportunities. We should be looking at collaborating with fintechs as a strategic, innovative partners. Enables us to sort of think differently about what we do, to change, to create the new market opportunities that we wouldn't have thought using traditional banking models. So collaboration can come in two forms. It either can be where a bank is collaborating directly with the fintech, or where I see where the real magic is collaboration between fintechs and fintechs. And I think this is something which has happened between the collaboration between Intex and Trade Tech, where they have found a solution to distribute trade assets into the capital market. So without further ado, I'm going to pass it over to Mike at Trade Tech, the brains behind AI and machine learning.
What we do at Trade Tech is that we provide a solution connecting banks to institutional investors. We heard a lot today about how smart machine learning and AI solutions enable better interface between corporates and banks. But because of the regulatory pressures and because of the optimization of the assets, many banks are driven to distribute trade finance to the institutional investors. What Trade Tech provides there is a network to distribute assets, network where on one side you have bank and non-bank originators, including some fintech companies. And on the other side of the network, you have institutional investors, investment funds, insurance companies, pension funds that want to invest in trade assets. We provide portfolio management solutions to these investors. We provide securitization as a service, transforming trade finance receivables into investable assets, the assets that can be delivered to a fixed income investor. And we also provide better transparency for the market by providing company and transactional credit scoring. There is a lot of work which needs to be done for trade finance to be investable by an investor, and a lot of that is about better information and better transparency. If you look on a supply chain, traditionally the credit analysis focuses on the entity which owes money. In case of trade finance, that would be the buyer. So we have here a schematic picture of the piece of the supply chain. We have a seller, a buyer, trade relationship, and a wider supply chain around them. Normally, the credit analysis is done on the buyer. The buyer are the one who have to pay. So obviously, there are credit ratings looking at them, there are credit scores, there are Z scores, there are credit bureau data on the buyer. Inevitably, in this situation, the information is very asymmetric. Sure, the buyer knows much more about their business than any credit rating can capture. So a lender has to take some things on trust. They have to price in certain amount of expected losses there. And in the end, if the buyer really wants to mislead or buyer are just very optimistic, there is not much that the funder can do about that. Trade finance provides very valuable context around buyer. First of all, we have the seller, and a lot of the decisions in trade finance are actually made based largely on the seller information. Seller have a history of working with the buyers. The trade relationship between seller and buyer can provide you a lot of repetitive transactions and patterns which can be useful. Some people actually use more or less directly seller information as a measure of quality of a particular transaction. Sometimes this is done very mechanically. Just seller credit rating sometimes comes into the picture in the analysis. What we do at this level of analysis, we provide AI-driven credit scoring. We look at the buyer, we look at all available information about the buyer, at their accounts, at the registration data, at mortgage charges. We enhance it with data from other sources. We use public data sources, like we map the address of the buyer to socioeconomic classification of the neighborhood. We use the data from the official publications on creditor meetings, and so on. And we try to get as much data which is not immediately provided by the buyer, but which comes from independent sources. Unlike traditional credit scores and credit ratings, we do full coverage. The countries where we cover full universe. For example, in the UK, we are doing credit scoring for the full universe of 3.5 million limited companies in the UK. We are also providing credit scoring in Singapore on a network trade platform, which is the official platform of the customs of the government of Singapore. And there again, we provide full coverage, credit scoring for all platform participants, covering all non-exempt limited companies in Singapore. A lot of data sits not on the buyer, but elsewhere on the supply chain. And to enable that, to unlock this data, we're looking at transaction scoring. There, the risk is assigned not to the buyer, but to a particular transaction. In trade finance, in practice, quite often, the risk of the transaction doesn't just depend on the buyer. For example, I was having coffee with an old friend of mine who is doing leverage loans. When he heard that now I'm in trade finance, he was actually a bit disappointed, because people in leverage loans absolutely hate people in trade finance, I should tell you. And the reason they hate them is that people in leverage loans quite often are facing workouts or bankruptcy situations. And what they see almost every time there is that even if trade finance instrument formally has the same seniority as a leveraged loan, in practice, the recovery there is much higher, and it's paid off first and the leveraged loan later. The reality is that if you are late on your mortgage for a few months, if you restructure your leveraged loan, you can easily continue to be in business and survive. If you stop servicing your trade finance obligations, your turnover stops there. You are not going concern. So trade finance transactions, especially with the key sellers, the sellers providing key goods for the buyer continued production, there are much higher quality instruments than just the credit quality of the buyer would lead you to assume. So in this sense, it's important to understand not just the buyer, but the seller and the history of the trade relationship and the nature of similar relationships. Credit contagion works in the supply chain. If you have a buyer of the buyer stopping paying the bills, that will affect the buyer ability to pay the bills. And in this credit shock transmission in the supply chain, that's where the opportunity is for the large originators. If you know that the buyer of the buyer is not paying the bills anymore, then actually it may mean that the particular transaction from this buyer is much more risky than the old transactions were, because sooner or later they will have to stop paying their bills. If you look farther on the supply chain, oops, I need the password. If you look farther out on the supply chain, if you are, for example, an originator working in an industry vertical or in a geographic locations, a bank or a non-bank originator, you may actually have information from farther out on the supply chain, maybe from the buyer of the buyer of the buyer. Your buyer will not have this information. And that's where you have this crucial opportunity to turn the tables, and that's where the lender can actually have a better information about the future of the business of the buyer than the buyer themselves have. Because you can observe this shock coming in the supply chain, you can observe it in advance. The way we apply this knowledge is that we look at the supply chain, and here is a portion of the supply chain on which we have our model calibrated. So we have around 3,500 companies here linked by trade relationships. A lot of the relationships are missing from this chart. There is probably much denser coverage in reality, but that's just the data we have collected. And even in that data set, we have a lot of early warnings of the problems. We can monitor here how the credit stress arises from a buyer not paying their suppliers, and then these suppliers can absorb the stress for a while, and then they stop being able to pay that. When we look at the supply chain, that immediately turns the standard problem credit analysis, that you don't have enough data, you don't have up-to-date data, you have too few points there, to the opposite problem, you have too much data there. You are observing daily dozens of transactions, or hundreds of transactions, or thousands of transactions, and you need to decide which of them are relevant for a particular buyer-seller relationship, particular receivable. That's what we use AI. We have quite sophisticated models modeling this graph as a whole, and then understanding the flows on this graph, and using them both to predict credit contagion and also to allow us to score transactions for new relationships, the ones which are not observed on the graph yet. And obviously getting data out of originators, getting data out of the banks is crucial here. Unlike company credit scoring, this does not rely on public data. This relies on private data sets of originators. So we work with a number of organizations to get this data and do the analysis for them. Normally, this analysis is requested by the investors, by people who want to have an independent view of the risks. But in practice, what we see is that originators themselves, once they have provided the data, they're asking for the results of the analysis as well, so that they can use it as well for their own purposes. And here to Andre about how this data can be extracted from the originators.
Now, when it comes to getting transaction data, and I'm saying it because we have the pleasure of having Finastra in the room. So Finastra, as well as other back office vendors like Surecom, China Systems, who are powering your back office on the trade side, have published over the last year or so APIs, so that the bank operating those systems can feed those value-added processes on credit scoring, on document scrutiny, on the analytics, can provide the back office data to those value-added processes based on machine learning. So there are options to do that, but of course sometimes you have systems that are not equipped with APIs, because they are proprietary systems developed in-house within the bank. And we often hear about the challenge for the bank to become digitally ready in order to feed those value-added processes. And this is what some technologies are making possible. Of course, a lot of players, and I just represent one here that is very specialized in that function of capturing data from various internal systems and making that available to value-added processes or to users via screens, reports, or dashboards, but also making that available to machine learning capabilities such as those that we heard of today. So what are the typical challenges when banks say, I'm going to start using my data and I'm going to start monetizing it? Well, first of all, monetizing it from the start is not obvious. I was discussing that with some of you yesterday. The first thing is to make data accessible to your clients to increase visibility. And we see that on the payment side. Dennis mentioned GPI. SWIFT has created this increased visibility on cross-border payments. And it's not necessarily something the banks can start selling to their clients, but it's actually certainly addressing a key benefit, or a key need for corporates to get more visibility thanks to having more data from the whole correspondent banking processing of those cross-border payments. So using data to serve your clients better, I think, is the first focus. Trying to get more revenue from the data, I think, would be a second stage. It's ideal, of course, but certainly providing more visibility and more on the processing of transactions, as StrateStream also offers, thanks to the whole digitization of the document process, and all of the fintechs also provide more visibility on the processing of different documents or transactions, is bringing key benefits to your clients. Now, when you want to do that as a financial institution, you hit some key challenges on the way. The first one is to access the data. You have an old DB2 system, IBM DB2. You have another technology there, and you have log files on flat files, and your IT team says no access. What do you want to do with that? There are security issues, different operating systems. So that's the first issue, is even for user to access the system is going to be a hurdle because of technical barriers and different formats and archives and encrypted storage that is basically existing in your environment. Then the second challenge will be to understand the data. You can get, as a user, an extract from your IT team, but then that raw data is formatted in a way that possibly is 20 years old, if it's an archive for history on payment flows, for instance, or it's indeed encrypted, and the user cannot really utilize the data as it is presented. And there is a need for interpreting the data based on the way it was stored, the way it was formatted. And we know, certainly in the payment space, a bit less in the trade space, the formats evolve continuously. And new formats have been invented, like XML formats 20 years ago, and powering now most of the European payments. And that's hard to read for users. So you need a certain level of functional intelligence to transform the raw data into something that is readable for the human being. Secondly, we're talking more and more about huge data sets. Certainly when we go granular around the payment history or other types of flows, like user activity, the log files, these are huge data sets. And if you want to start analyzing that, the typical back office systems, the technologies they use are not geared towards high volume data processing. So this is where, in terms of infrastructure, the technology world has invented new database technologies, not relational databases, but other types of databases to handle really huge data sets. And that's the infrastructure challenge that is often faced when the use case requires huge volumes to be handled. And then finally, the delivery challenge within major organizations. Accessing data, using data for value-added processes is not on the top of the list, is not regulatory, is not on the regulatory list. So often, in terms of budget allocation, in terms of team allocation and organizational structure, you're not on the top of the list. So you better have a separate team, separate structure, budget to run those data projects. So basically, there are now technologies that are enabling, and that's what I'm going to quickly cover, these challenges by really specializing in capturing data and making that available for your internal needs, whether you combine this data with your own direct user or your value-added processes such as the ones we saw. When it comes to the collaboration with TradeTech on the credit scoring, definitely the goal is here to enrich the credit scoring machine learning capabilities of TradeTech with all the possible historic payment flows that we can find in banks' archives and in all those archives that contain the payment initiation messages, whether they were on SWIFT or on other clearing systems, as well as all the statements, because all those payments and statements contain basically the whole history of the payment flows between two parties. So basically, the value of a technology like Intix is to go and get the data and understand how it was formatted 15 years ago, 5 years ago, or today. Understand that this was a real-time payment, the other one was a cross-border on SWIFT, another one was a SEPA batch payment, having all that functional intelligence and being able to provide that in the way that is expected by the machine learning to enhance the credit scoring quality that the trade tech proposition will deliver to the bank. So it's all about feeding the machine learning with a maximum number of data sets, depending on what you, as a bank, still have in store. Of course, in your production systems, you have it because you process it on a daily basis, but you also have, from a legal perspective and regulatory perspective, you have archives that should be available somewhere, and the Intix technology can go and access, or you can use the Intix technology to go and access that data, whatever the technology you have chosen 20 years ago to basically store those archives. So basically, that's the proposition here, to combine the specialized data capture technology of Intix. Of course, it could be another one. There are other technologies, of course, to do that. And whether the machine learning, so on the trade tech on the right-hand side, needs data from the electronic banking system or the trade system or the payment system, from long-term archives, from the screening system, all of those systems can be plugged onto the Intix data management layer, and that has the understanding of all those formats and the data structures, and that will create an information bus, an information layer that will feed the AI-based capabilities of trade tech. And of course, the same model, we heard Rebecca mentioning Intix for the Coriolis proposition. So you can basically repeat that same structure for any type of value-added processing that you may, where you may require data from internal systems. And of course, this can be done in real time. Capturing data can be done in real time. And sometimes we're getting asked, how can you capture data in real time from very old legacy systems? This is because we're working with standard technologies from those database providers like IBM with MQ series. You have replication technologies that we tap into, or Oracle. And there are data technologies that enable updates in databases to be replicated in real time. And this is where Intix can tap into those middleware capabilities to provide the information for value-added processing. So definitely this is about addressing the technical infrastructure issue. This is not about becoming a trade system or a payment system. This is an information system. And again, in this case, feeding a very specific value add. And I think that's making the fintech to fintech collaboration quite nice in terms of combining very specialized role and making sure that you're getting full control of the process, because such an infrastructure is installed on premise. That means that there is no data being externalized. This is a software solution that is installed within your environment, and that will keep your data in your domain of responsibility, in your environment. There is no need to externalize this. Possibly on the AI side, some functions could be externalized if the AI provider is running on the cloud, but also many of those AI providers can install their value-added capabilities on site, so that all the processing is also performed on site within your premises. So basically, we are really talking about a data management layer that plugs into the existing infrastructure. And as Daniel was saying, this is the beauty of those fintech propositions. By being very small and specialized, because those companies are still very small, like less than 100 people each, sometimes less than 50, those fintechs do not aim to change what is working well. They don't suggest you need to move everything to blockchain, because otherwise in 5 years' time we'll still be here waiting for results, because we know the blockchain move will take a few years before being really impactful. So we don't suggest to change what is working, but we suggest to add value where pain points are located so that you can get more value out of existing systems. So that rather than calling those legacy systems, which can sound negative, I like to call them robust systems, because your back office systems are robust, proven, and the value add can be added next to those rather than suggesting to change those. And again, this is also an approach that the large back office vendors take by providing APIs on top of their existing infrastructure. So you have multiple options, of course, to extract data from systems. But of course, when you're talking to a back office system, you will only get the data that they process, and not all systems in a bank are operated by the same vendor. And this is where specialized technology can provide a generic answer. I have covered here the API capability to a third-party process, working with StraightStream, Coriolis, TradeTech, for instance. But also, this data can be processed by the technology itself to monitor flows. So there are other use cases where the transactions are being automatically reported. That's an easy use case indeed. But also tracked, so that the transactions as it evolves can be tracked, can be monitored, and fraud prevention can be implemented on that technology in order to prevent indeed collusion fraud. And this is to detect that a payment was changed internally following some fraud, collusion fraud. And such technology, by tracking the transactions, will spot that one field in a particular payment instruction has been changed, a bit like what happened in the Central Bank of Bangladesh in February 2016, where they managed to send a SWIFT instruction to the Fed and steal 80 million. That is a kind of use case where such data technology can spot those internal fraud issues. So basically the message is getting access to the data can be done with technology, can be done with the large vendors, can be done with specialized players, whether you need to access any type of database, any type of system, it can be done. Again, in association with the database technologies that you already use, the IBM NQ series or the DB2 and the Oracle of this world or other databases. Understanding the data, tracking of all those formats, understanding all those formats is part of such a proposition, and making the data available in the right way. Okay, Rebecca talked about aggregated and anonymized data. I mean, in all those implementations, you control what you extract, you control what you share with other applications or external providers. So it can be aggregated data, it can be granular data. Michael would prefer granular data for the credit scoring. So all of that can be automated in those data technologies. And here, just an example of interception points in order to monitor the evolution and tracking the transactions. The data tracking technology would actually check the status of a particular transaction at different points across your internal infrastructure to basically identify indeed changes that were introduced following fraud, or to also calculate the performance or identify payments that are being blocked in a particular system for no reason, and before the client calls saying, where is my, how is my payment being processed, what is the status, you can from the operations side know that out of millions of transactions there is one that is aging in a particular system, and that requires your attention. The expertise within each fintech is very special. There is no credit scoring expertise at Intix. It's all about technical database access and following the evolution of all the formats in the world and understanding all of those Swift formats and ISO formats that the world is producing and documenting or publishing on a continuous basis. And this is where there are opportunities to collaborate. I think if you're looking at the retail side on the web, there is collaboration between websites. You click on one button and suddenly it goes to Google Ads before going to another website and then finally getting to the page you want. This is also a collaboration between providers on the web in the retail side, and this is what we definitely can achieve here as well on the very slow-moving, I would say, trade finance market. But I think the slow-moving will gradually evolve as you start adopting those technologies. So with this, I'd like to hand over back to Daniel to check for questions.
So now we're going to move on to sort of the panel discussion. I've got my questions here, so I think we do have enough time. Sean, you're looking at me. We'll keep it, reasonably short. So anyway, get comfortable. So I think one of my first questions, actually this is more relevant to you, Michael, at TradeTech. You've obviously sort of developed this machine learning credit scoring model. And I was just wondering, it's obviously used by the the funds to buy trade assets. How receptive have they been to this credit scoring methodology that you're using? And is there any regulatory requirement from their side to get approvals to use it?
Well, it really depends on the type of client. Any client wants better credit transparency. Most clients don't like to rely on banks to provide all of the information because banks or originators are the sellers in this transaction. So the incentives for them are not aligned to be pessimistic about the credits. So there should be some source of third-party credit assessment. When the credit is rated, then I think all clients would take the rating because public ratings is a well-established way to assess credit risk, supported both by the tradition, by the system, and by the regulation, very importantly. However, many investors are coming to trade finance for more higher yielding, more granular exposures. If you look globally, there are around 20,000 names covered by one of the big three rating agencies. There are around just over 30,000 names globally covered by at least two banks for the internal rating. And just in the UK, there are 3.5 million limited companies. So a lot of trade finance is the most of it. The vast majority of companies are not rated. So they need some source of transparency there. And that's what our system delivers. Our system doesn't make just voluntaristic judgment that I like this credit, I don't like that credit. It's all fully evidence-driven and driven by the historical experience with actual payments. The transaction scoring doesn't rely on information provided by just one party. These transactions are between at least two parties, buyer and seller. They've been also vetted by the funding provider. So to really, this data is much more reliable than, for example, non-audited accounts of a small company where actually just the accountant who looked at them and nobody else might have checked these things. When it comes to the regulatory vetting, then we haven't yet had formal regulatory approvals in the industries where this is required. For example, the internal model approval in the European Solvency II framework, we didn't get there yet, but in other cases, the internal approvals of the regulated companies, that's already happened. And they did rely on our scoring for decision making there.
Okay, thank you. So you're obviously with this credit scoring model that you've got, you're relying on both information that the seller has to create that scoring, but also external information and data. What sort of format of data do you require to make that credit score? So what information do you require, say, a bank to share with you on that platform?
Well, the crucial information is the transactional information. So we need, for the relevant book of business, We need to see some number of transactions. And it's quite important not just to see the good transactions. Well, the vast majority of trade transactions are actually quite good. They do get repaid. But it's important to see some history of non-payments or very late payments of insurance claims. And that's the kind of information that we calibrate the model on. We don't just make judgments about good transactions, not liking them. So we need to see history of failures as well as successful transactions. It's important to have non-censored data. So obviously from the seller point of view, there can be an incentive to edit data to filter out the worst cases. In that case, obviously the model will not be calibrated properly if the worst transactions are removed from there. In terms of what other data we need to get apart from the history of transactions, we do need to get reference data, the data on the buying and seller corporates. That helps on any relevant macro variables there. In terms of how we get the data, we're quite flexible there. We can connect through an API to the internal system. We can get, in many cases, we get just simple flat files and CSVs. In some cases, we parse very complex folders with lots of Excel files, storing data not always consistently between them. Yeah, so that varies. Obviously, the data was provided in a nice structured format that removes a lot of work for us.
Okay. And obviously, when banks who are looking to sell trade assets, and they're obviously sharing this information, this data with you, they operate in different jurisdictions, and we heard earlier about the regulatory requirements around data sharing. I guess what solutions are there to address that issue? And I think, Andre, perhaps you're best to answer that question.
Yeah, definitely a lot of regulatory impact, not only on the transferability of assets, as was discussed, and that remains an ongoing issue. But I think on the technology side, for those fintechs like TradeTech and others that are working using cloud technologies, when they are confronted with banks that are not allowed to move the data out of their country, I mean India, Luxembourg, Geneva, we see that, and correct me if I'm wrong, but so some fintechs are using Microsoft Azure that is actually embedding those regulatory requirements into their technical layer. So, and I'm sure other providers are doing the same, Amazon and others, Google. But basically, the cloud infrastructure that those fintechs are using in order to aggregate data coming from banks can take into account or takes into account your regulatory restrictions when it comes to moving data out of your jurisdiction, depending on, of course, your requirement. So that's a kind of good news because it makes those cloud technologies much more accessible to us as a regulated industry. I remember 15 years ago that was an ongoing discussion, or maybe 10 years ago, because those Microsoft of this world were not ready with those infrastructures. But maybe there are some fintechs in the room that have a similar experience. I know TradeTech is what you're doing with Azure. Yeah, to address this requirement. 15 years ago, Swift built a whole infrastructure in India in order to win the domestic Indian market. So Swift had to build a new operating center, put a whole new IT team in place in the country to get domestic messaging in India. But now with those cloud infrastructures provided by big players like Microsoft and others again, some of those issues, at least on the technical side, are addressed. But there are other issues when it comes to transferability and assignment of receivables. That's definitely another ball game.
Okay. Yeah, I would add that, yeah, so we are using Microsoft Azure, and when necessary, we can move data processing to a different part of Azure. For example, I expect that we'll move some stuff soon from the UK cluster to somewhere on the continent. We're already using, for some things, the cluster in the Southeast Asia. A lot of our models, once they're calibrated, actually can be deployed on internal client systems. So we have technology called, we kind of put models in the containers where they can be deployed to any compatible hardware installed, for example, on premises for the client as well.
I think just one last question is how do you see sort of machine learning, AI developing the trade distribution space in the future? Obviously in the investment banking world you've got robotic advisors. Do you think it's going to get fully automated, or are we a long, long way away from it?
Well, the development of machine learning goes in several directions. Some of it is improving the models, and I think the models can still be improved quite a bit. But in many cases, the biggest progress is made by putting more data into the models. And when one tries to put more data, some of this data is easy to analyze. You have each company has a bunch of features. These are very simple textbook applications of machine learning. Other data has much richer structure. You have the supply chain, for example, data, which has a structure of the graph and flows on the graph. You have the temporal graph data in the shipping data, in the reference data for the trades. And it's getting the up-to-date, timely feeds for this kind of data and having the scalable models which can take all this emerging data, maybe from the Internet of Things, being able to data mine the blockchains, not mine the blockchain in the Bitcoin sense of word, but data mine it to get the relevant trade information for specialized blockchains. So I think that's where the development is going to be.
Okay. Well, I think now I'm just going to hand it over to the audience if you've got any questions or perhaps not, maybe with the timing.
To make your credit assessments as well as bank information, internal information. And you stressed the point about it's useful to have late payment history data as well as missed payment history data. Quite often, looking at a missed payment or a late payment in isolation, it could be viewed out of context. There could be a legitimate rationale for that. Quite often that would be maybe captured in client conversations that the RM may have, which may or may not be documented. How do you account for that so as not to distort your rating, or do you expect that information to also be shared?
Yeah, well, our models are fully data-driven. So to the extent that the late payments are not then usually followed by, for example, massive dilution on the payment, or the payment which leads to raising an insurance claim, as long as there is no bad event following typically for this kind of clients for late payments, the model would not be penalizing clients for that. The model would penalize just moderate late payments only to the extent that for this kind of clients in this kind of position on the supply chain, they're usually followed by something which leads to economic losses. So yeah, it's evidence-based. If in reality some moderate payment delays don't lead to anything untoward, the model is not going to be penalizing for that. Unless you define untoward as 3 days late on the payment, but that's not a very interesting thing to predict, because in trade finance people usually don't care about this kind of events.
Okay, thank you. Well, I think on that note, I'll hand it over to Sean.
We've overrun so much because it's been so great. I'm sure I'm biased, but I think this has been absolutely tremendous afternoon. Tremendous quality of speakers. Thank you to all of you, to all our fintechs that were on stage today. Thank you to the moderators, to Joe, and to Daniel, and to Andre, of course, for organising this. We will have all our fintechs who want to come in Budapest or at our annual conference, and they will be. There's a whole morning, in fact, a whole half day devoted to what they do, so that they can show you what they do, and you can have bilateral conversations with them. So I hope you turn up for that. A lot of other things, of course, happening in Budapest as well, but that's just one side of it. Bliss it was in that dawn to be alive, wrote William Wordsworth, and I really feel I've seen a real dawn here. I'm surprised because I do follow this, but there's a lot of new stuff, and I feel very blissful. So if you want to be blissful as well in the traditional way, please join us next door for drinks. With that, I'll close this afternoon. Thank you, everybody, and see you next door.
So that's